You see the headlines, major bank launches Bitcoin fund, and you think, great, the party is just getting started. This is a fatal miscalculation. You are not witnessing the beginning. You are witnessing the moment the professionals have arrived to build the permanent structure on a foundation that was already laid. They are not here to speculate with you. They are here to systematize the market, and the price of entry into their system will be far higher than you can possibly imagine. I need to state this directly. The primary risk parameter associated with Bitcoin is not price volatility. It is the risk of delayed acquisition. Most people believe the main danger is the price falling. They are mistaken. The market's schedule is not indexed to your analytical process. The debate on its viability concluded when major financial institutions began engineering custodial solutions and collateralized lending products. This is not experimentation. It is the construction of permanent infrastructure for mass capital allocation. I have spent a great deal of time with the people who make these decisions. I saw the moment they stopped arguing and started preparing. While you are waiting for an optimal price point, they are building the high-throughput channels through which institutional capital will move. My own bet has been made. I am not interested in who agrees. I am interested in who will act in time. You must understand that institutional adoption is not a market trend. It is a structural change to the financial system. Large-scale capital does not enter an asset class to merely observe. It enters to deploy at scale within systems it understands and controls. When global banks offer Bitcoin-backed instruments, they are not merely selling an asset. They are selling structured access on their terms, through their systems, and with their fee structures. They are not giving you freedom. They are selling you convenience. As a result, the easiest and most visible paths of access will increasingly favor intermediated ownership. Direct, unencumbered ownership, the kind that represents true property rights, now requires greater intentionality and greater responsibility than it did before. The window of opportunity does not close with a loud noise. It closes quietly, and that is what makes it so dangerous. By 2026, the arrival of regulatory clarity is not a signal for retail validation. It is an operational green light for institutions possessing the legal and compliance frameworks to act decisively and at scale. This clarity allows them to shift from cautious private positioning to aggressive public acquisition and product deployment. Every piece of new regulation solidifies their ability to operate efficiently, while simultaneously making direct entry for the individual more structured, more intermediated, and less frictionless than it is today. When the regulatory environment becomes clear, they no longer need to hide. They can act publicly, quickly, and on a massive scale. At that moment, the average person is left with a single unpleasant question. Did I truly believe I had more time? The normalization of Bitcoin as a standard financial asset follows a predictable path. First, bespoke products for high net worth clients. Second, regulated exchange-traded funds for the mass market. Finally, direct integration into standard banking applications. This progression is already underway. By the time owning a Bitcoin allocation is as simple as holding a savings account, the period of maximum asymmetric advantage will have passed. The price will cease to be a topic of conversation because the market will be saturated with late entrants. The fundamental error is not failing to acquire the asset, but failing to do so while its risk-to-reward profile remains meaningfully skewed in favor of early, intentional ownership. Later, you can buy it at a higher price. Later, you can buy it through a bank with a commission, but you cannot buy early access later. Price is a variable that can be overcome with more capital. Intermediary fees are a cost that can be paid. However, time is the one input that is irrecoverable. Each period of inaction is a direct transfer of opportunity from those who are deliberating to those who are executing. The fundamental miscalculation is to focus on the cost of entry in dollars, while the sophisticated actors are focused on securing a position within a narrowing time frame. You were arguing about the price while others were acquiring the time. This is the crisis point. The realization that time, not price, was the scarce resource all along. Time is the only thing you cannot buy more of later. MicroStrategy's capital allocation strategy is not a speculative trade. It is the logical conclusion of an engineering analysis. We are systematically converting a balance sheet of deteriorating fiat-denominated assets into a treasury reserve asset engineered for long-term value preservation. We operate under the premise that the new standard has already been selected by rational actors who are now building the infrastructure around it. Our conviction is not based on short-term price appreciation, but on the mathematical and economic properties of the network itself. I made this decision based on responsibility, not emotion. I am acting as if the new standard for savings has already been chosen, and my only task is to secure a position before it becomes the norm for everyone else. The search for an ideal entry point is a strategic error derived from a flawed premise. You believe you are timing a market, whereas what is actually occurring is the construction of institutional-grade financial infrastructure. While you and other retail participants analyze price charts, global financial entities are engineering the high-capacity channels through which the next $1 trillion of capital will be allocated. They are not speculating on price. They are building systems for permanent capital deployment. Each day spent waiting for a better price is another day those systems mature, increasing the share of future demand that will inevitably flow through these new intermediated paths of access. You are looking at a clock, thinking you have time. They are laying the railroad tracks that will determine where the train goes. This institutional rollout is not a singular event, but a phased process designed for progressive market integration. Phase 1 involves creating secure custodial products for high net worth clients who demand safety over any deep technological understanding. Phase 2 is the launch of simple, regulated, exchange-traded funds for participants who fear operational error and prefer a familiar ticker symbol. Phase 3 concludes with the integration of Bitcoin into standard banking applications as a familiar savings instrument for the mass market. Each successive phase makes acquisition easier. Each phase shifts the center of gravity for demand toward convenience and away from direct sovereign ownership. This shift does not happen by force, but by preference. The system is being engineered to make the intermediated path the path of least resistance. You must understand what is being sold. The products offered by these financial institutions are not engineered to grant you sovereignty. They are engineered to sell you convenience. Convenience is a fee-generating service that abstracts away the operational responsibility of self-custody. The price of this convenience is the acceptance of counterparty risk and diminished control. When you use these services, you are not holding the asset directly. You are holding a regulated, intermediated claim on the asset. The long-term cost of that abstraction, in fees, in dependencies, in risk, will exceed the operational cost of maintaining sovereignty for those willing and prepared to assume it. Convenience always costs more than freedom. Once this institutional infrastructure is mature, the focus of the public discourse will shift. It will shift from the volatility of the asset to the reliability of access. Volatility will cease to be perceived as the primary risk. The primary perceived risk will become counterparty exposure. The risk that your claim on the asset depends entirely on the integrity and solvency of an intermediary. By the time the market is saturated with these late adopters, the daily discussion about price will fade in importance. The cost that will matter most will be the hidden cost of access and the explicit cost of dependency on third-party systems. The window of opportunity is not closing through prohibition or through exclusion. There will be no dramatic ban on direct ownership. Instead, it is closing through normalization. The institutional channels will become so dominant, so convenient, and so widely adopted that alternative paths will appear inefficient and complex by comparison. Direct sovereign access will almost certainly remain possible, but it will become increasingly uncommon. It will be a path chosen only by those who deliberately prioritize absolute property rights over engineered simplicity. The choice will be available, but the system will be designed to guide the vast majority away from it. The final stage of this process is the transformation of Bitcoin from an early adopter asset into a standard reserve asset within the global financial system. At this point, the opportunity for extreme asymmetry is reduced. It is not eliminated, but it is normalized. You are no longer an early participant in a misunderstood technological system. You are simply a user of a recognized global monetary network. And on that day, you will realize that while you were debating the price of entry, others were securing a temporal advantage. They were not buying a price, they were acquiring a position in time, a resource that can never be recovered. I have observed the shift in institutional positioning, from public skepticism to neutral analysis, and now to active product development. You must not misinterpret this as an ideological conversion. It is a calculated response to a fundamental business imperative, the risk of losing clients to competitors who offer access first. Their actions are not philosophical endorsements of a new technology. They are economic signals of an unavoidable systemic capital reallocation. They are not changing their beliefs. They are defending their market position against attrition. When the choice is between maintaining a skeptical posture and losing a client's assets, the decision is predetermined by the logic of their business. You must also understand the function of regulatory clarity as it materializes in 2026. It does not function primarily as a retail protection mechanism. It functions as an institutional activation signal. It provides the precise legal and compliance framework necessary for publicly traded entities and fiduciaries to deploy capital at scale without exposing the individual decision makers to career risk. The moment regulation becomes predictable is the moment execution begins. The strategic plans were already in place, waiting. The clarity simply removes the final operational friction, allowing them to proceed without ambiguity. The transition from this phase of institutional preparation to active execution will not be linear. It will be rapid. Once the regulatory and operational frameworks are finalized, capital deployment will accelerate at a pace that the retail market is not accustomed to. Large corporate and financial balance sheets do not speculate incrementally. They reallocate capital decisively based on board-level mandates. The scale of this coordinated shift will create a demand pressure that most market participants will only recognize in the aftermath, after it has already been reflected in the price and the structure of the market itself. This acceleration will force the individual to confront a critical miscalculation: the assumption that time was an abundant resource. The period you perceived as an opportunity for optional research was in reality a diminishing window of strategic advantage. The most dangerous question you can ask yourself is not, "Is this a good investment?" but rather, "Did I assume I had more time than I actually did?" That error is not a financial error. It is a temporal error, and it is far more severe. The market provides mechanisms to correct for pricing mistakes. You can buy the asset later at a higher price. You can buy it later through intermediaries with their associated fees. You can pay the spreads and commissions that will exist later. But the market provides no mechanism whatsoever to repurchase early access once that period has passed. Time is the only variable in this equation with zero elasticity. Early direct exposure to the network is itself a finite asset, and the available supply of that asset is being consumed with each passing day. This is the critical mistake. You are debating the wrong variable. The public discourse is focused on price volatility, a secondary and ultimately manageable attribute. The rational actors, the institutions, have been focused on execution. They understand the sequence. The tragedy is not that you will be priced out of the market. The tragedy is that you may be timed out, forced to enter a market whose fundamental terms of engagement were permanently set before you decided to act. You will not be a participant in its formation. You will be a user of a system they designed. My decision-making process is not predicated on emotion. It is an exercise of fiduciary duty. The standard for long-term value storage has already been engineered, and it has been objectively evaluated based on its properties. My objective is to establish a significant position before its role as a global monetary standard becomes broadly and publicly acknowledged. I am not waiting for consensus to form, because consensus is always a lagging indicator of a concluded event. We act based on the engineering analysis of an existing, functioning system, not on a speculative belief in an unproven future. This is a matter of responsibility, not of sentiment. I operate from the simple premise that the most sophisticated actors in the global financial system have already reached their conclusions. My actions are therefore the logical consequence of observing their preparations. When major financial institutions begin to build permanent infrastructure around an asset, they do so because they have determined that future demand is inevitable, not hypothetical. They are committing capital and resources to a certainty. I am simply interpreting those clear, unambiguous signals before they are universally recognized by the broader market. I am not waiting for permission to believe. I am not waiting for the crowd to approve. I am observing the actions of those who make the decisions that matter. The entry of these financial institutions into this domain is frequently and fundamentally misunderstood. They are not redefining Bitcoin. They are adapting their business models to its existence. Their primary objective is to ensure that the majority of future capital flows through compliant, scalable systems that they can service and control. They are not changing the nature of the core network. They are building proprietary access layers around it. When they support this asset, they are not supporting the decentralization of power to the individual. They are supporting their own continued control over the points of entry and exit. They want the late mass market demand to come through their doors, on their terms, with their commissions, at their price. You must understand that the institutional product suite, the exchange-traded funds, the managed custodial accounts, the derivatives, is an architecture of convenience. It is a system designed to abstract away complexity in exchange for recurring fees and absolute trust in intermediaries. This model will successfully serve the majority of future adopters, but it is categorically different from the sovereign ownership of the underlying digital asset. Understanding that distinction is the most essential piece of knowledge in this entire domain. One is ownership of a claim, the other is ownership of the property itself. The terminal outcome for most participants in this market will not be an error in price. It will be an error in timing. They will eventually arrive, but they will arrive in a mature market with defined access points and established norms, long after the period of maximum optionality has passed. They will pay the market price of that day, and that is all they will get. The temporal advantage, the asymmetric opportunity, will already belong to those who acted when the outcome was logical, but not yet obvious. The moment of collective realization will not be subtle. It will not be a gradual dawning. It will arrive as a headline, a major policy announcement from a regulator, or a coordinated institutional disclosure. On that day, public perception will shift with irreversible rapidity. Doubt will no longer be framed as prudence. It will be correctly identified as a costly delay. And every moment of prior hesitation will be understood for what it truly was: the voluntary and permanent surrender of time to those who chose execution over deliberation.